manage the money supply and influence economic activity. The goal of monetary policy is to promote healthy economic growth, stable prices, and full employment. Central banks use a variety of tools to implement monetary policy, but the most common are interest rates. Central banks can raise or lower interest rates to make borrowing more or less expensive. When interest rates are low, borrowing is cheaper, which can stimulate spending and investment. When interest rates are high, borrowing is more expensive, which can slow down spending and investment. Open market operations. Central banks can buy or sell government securities in the open market. When they buy government securities, they inject money into the economy. When they sell government securities, they drain money from the economy. Reserve requirements. Central banks can change the amount of reserves that banks are required to hold. When reserve requirements are high, banks have less money to lend, which can slow down the economy. When reserve requirements are low, banks have more money to lend, which can stimulate the economy. Monetary policy is a complex topic, but it's important because it can have a big impact on the economy. When the economy is doing well, central banks will typically use a neutral monetary policy, which means that they will keep interest rates and the money supply at stable levels. But when the economy is in a recession, central banks will use an expansionary monetary policy, which means that they will lower interest rates and increase the money supply in order to stimulate spending and investment. And when inflation is high, central banks will use a contractionary monetary policy, which means that they will raise interest rates and decrease the money supply in order to slow down the economy and bring inflation under control.